I just saw a video of this girl who said she's been paying off her mortgage for 3 years, but when you see how much has actually come off the loan, I think you may just pass away. Let's watch the clip, then I'm gonna tell you what went wrong and how you can make sure that this doesn't happen to you. And who am I to talk about this? I'm a self-made millionaire and published financial author who teaches you how to win with money.
That means that I actually only paid down my mortgage by $2,631, even though I have literally gone with $50,000.
Basically, she's saying she has made $55,000 in mortgage payments over the last 3 years, and she has only paid down her loan by about $2,000. What it sounds like to me is she took a variable rate mortgage with a fixed payment. What this means is the interest rate that you will pay on your mortgage changes as the prime rate changes, but the payment stays the same. So if rates go down, then the amount of money that you're putting towards principal actually goes up. So you're paying that loan off faster. But when rates go up, that means you're actually putting less towards principal, more towards interest, and that means it's going to take you a lot longer to pay off that loan. And we all know rates have been going up and not down. And this is super concerning for people with this type of mortgage because a lot of them now are in a situation where they're basically making interest-only payments. They're like renting their house from the bank. Now, the most insidious part of this is that while you are making these interest-only payments, the amortization or the amount of time it's going to take you to pay back your loan goes up. Now, I have seen some of these go from 25, 30 years to 60, 70, 80 years. And the thing is, banks are not going to allow you to keep an 80-year amortization. So what happens when their mortgage comes up for renewal at that 5-year mark is they're going to need to bring that amortization back down to 25 or 30 years. So how are they going to do that? They can put down a large lump sum at the end of the 5-year term to try to bring that mortgage back down to where it should have been had they been making the additional payments to account for the higher interest rate. Or they're going to need to refinance the loan to bring that back down to 25 or 30 years. And they're going to see likely a very big increase to the amount of money that they have to pay for their mortgage every month. Sometimes either of those options are not going to be affordable for people. And the third option then becomes you got to sell the house. So if you have a variable rate mortgage with a fixed payment right now, you should start putting additional money onto that mortgage so that it puts you in a better position financially and opens up some more options for you.